Welcome back to Options Guide, where we don't just teach strategies, we teach you how to think like a successful trader. I'm your host, and this might be the most important video you ever watch on trading. You can master every strategy, but if you don't master your psychology, you'll still fail, just like 95% of traders do. Let's dive into the mental game and learn how to rewire your brain for success. The Dopamine Trap. Let's start with the neuroscience of why trading can become addictive. Every time you place a trade, your brain releases dopamine, the same chemical involved in gambling and drug addiction. Here's the kicker. It's not even about winning. Your brain gets a dopamine hit from the anticipation of making money, not the actual profit. Research from Stanford shows that the anticipation of reward triggers more dopamine than the reward itself. That's why you can lose a trade and still feel the urge to place another one right after. The addiction cycle. You win. Dopamine hit reinforces behavior. You lose, your brain craves the high and pushes you to chase it. So you increase trade size, take more risk, and spiral out. I've seen traders turn $10,000 into $50,000, then lose it all in 1 week chasing trades just to feed that high. They weren't trading with a plan anymore. They were trading for brain chemistry. Warning signs you're stuck in the dopamine trap. You think about trading constantly. You feel anxious when markets are closed. You increase position size after wins. You trade impulsively. You hide your trading from family or friends. Studies show about 2.5% of traders exhibit compulsive behavior, similar to gambling addiction, and they lose 43% more annually than disciplined traders. The overconfidence bias. This is one of the fastest ways to destroy your account. It usually starts with a few early wins. Let's say you start trading with $5,000. You make a few smart trades, turn it into $8,000. You think, I figured this out. But what really happened? You got lucky in a rising market. The overconfidence spiral. Small wins, inflated ego, bigger positions, looser risk management. Shift to complex trades you don't fully understand. One big loss wipes out months of gains. A trader I know grew $10,000 to $25,000 using basic covered calls. Then he thought he was a genius and switched to trading zero DTE options with his full account. 2 weeks later, back to $8,000. That's the Dunning-Kruger effect in action. People with limited knowledge often feel overconfident, and it's deadly in trading. Overconfidence red flags. Selling naked options without hedging. Trading earnings blindly without understanding IV crush. Ignoring position sizing rules. Believing you can consistently time the market. Dismissing diversification as unnecessary. Reality check. Even professional traders with 20-plus years of experience lose trades every week. If you think you've cracked the code after 3 months, you're in danger. The revenge trading cycle. Revenge trading is the most destructive psychological pattern. It's when you try to get back at the market after a loss. You lose $1,000 on a trade you were sure about. Instead of taking the L, you immediately open a bigger trade to make it back. That one fails too. Now you're down $2,500. The cycle escalates. The 5 emotional stages of revenge trading. Denial. It'll bounce back. Anger. The market is rigged. Bargaining. If I break even, I'll trade safer. Revenge. I'll show the market who's boss. Devastation. How did I lose everything? During this spiral, your prefrontal cortex, the rational part of your brain, goes offline. You're not making decisions, you're reacting emotionally. Real example. A trader loses $500 on Apple calls, buys $2,000 in zero DTE calls to make it back fast. Stock doesn't move. He doubles down with $5,000 in puts. Apple rallies, and now his $10,000 account is worth $2,500. How to break the cycle. Set a daily loss limit. Take a 24-48-hour break after a big loss. Never increase position size after a loss. Journal your emotions after every trade. Use predefined stop losses and exits. Position sizing psychology. Want to know the #1 habit of traders who don't blow up? Smart position sizing. And guess what? Most traders get this completely wrong because of emotions. Pro traders use systems like the Kelly criterion to calculate optimal size. Retail traders? They go with gut feelings, and it backfires. When traders risk too little, they're scared from previous losses. They take tiny positions that can't recover past losses. Fear keeps them stuck. When traders risk too much, they get greedy after a win. They double or triple their size hoping to accelerate gains. This is when accounts blow up. The golden rule? Never risk more than 1 or 2% of your total account on any single trade. Example, if you have a $50,000 account, risk per trade is $500 to $1,000. If buying calls, that's 2 to 4 contracts. If selling spreads, that defines how many spreads to sell. Benefits of proper sizing: keeps emotions in check, prevents revenge trading, allows consistency, makes losses manageable, builds long-term confidence. A trader making just 2% a month doubles their account in 3 years. A trader chasing 20% a month usually loses it all within 6 months. Building a systematic approach. The only way to beat your brain is with systems. Here's the exact framework top traders use to stay disciplined and remove emotion. Pre-trade checklist. What's my max risk? What's my profit target? What's my exit plan? How does this fit into my portfolio? Am I trading based on logic or emotion? Journal every trade, not just price and PL, but also your mindset. Ask, how did I feel placing the trade? Did I follow my plan? What could I improve? The 24-hour rule. Never trade immediately after a big win or loss. Take at least a day to reset. It prevents revenge trading and overconfidence. Automation tips. Use stop-loss orders. Set alerts instead of watching charts all day. Use a position sizing calculator. Have weekly and monthly loss limits. Mindset shift. Amateur traders. Think, this trade will make me rich. I need to be right. I feel like this will work. Pro traders. Think, this is one trade in a series. I manage risk, not outcomes. No trade is guaranteed. I follow the system. Trading psychology isn't fluff. It's the difference between success and failure. Dopamine addiction, overconfidence, and revenge trading destroy accounts every day. But now, you know how to fight back. Build systems, follow your rules, and treat trading like a business. Your job isn't to be right. It's to survive and grow consistently. If this video opened your eyes, smash that like button and subscribe for more content that goes deeper than just strategies. Comment below. What's your biggest psychological challenge as a trader?